institution that has weathered the Second World War, the partition of India.
Long years ago, we made a tryst with destiny, and now the time comes when we shall redeem our pledge.
A full-blown balance of payment crisis, and more recently the worst global financial crisis in 70 years. As a banking regulator, it serves the myriad financial needs of a fast-growing economy. While as the monetary authority, it protects the poor and the middle class from the scourge of inflation. An institution that pumps lifeblood of liquidity into the Indian financial sector and keeps it running like a well-oiled machine. Not too fast, not too slow. None of these tasks are easy. One misstep can lead to a debilitating crisis. If we in India have avoided falling into a financial black hole, the credit must go to the Reserve Bank of India and the 22 men who have headed the apex institution at different times over the past 75 years. The men who have collectively shaped the age of prudence.
Examples to emulate. The Reserve Bank had the problems of India were sui generis, and the Reserve Bank had to try to fashion its policies and devise policy instruments to meet the needs of a developing economy.
RBI has saved the country many times, but the most important one is the latest occasion on which the RBI has stood between the country and financial regress.
It was a terrible time. Giants of Wall Street crumbled like sandcastles. Others teetered on the verge of extinction. The crisis, which had its origins in the gigantic housing boom, brought back fears of the Great Depression. Global trade froze up. Economies around the world went into a deep funk. India, though, emerged relatively unhurt. Sure, factory production and exports slumped, but the banking system was resilient, and that kept panic at bay. The credit for keeping the Indian financial system safe goes to Governor Y.V. Reddy, or Anti-Greenspan, as he was called in some circles for his hawkish stance on asset bubbles.
Those who called him conservative then are saying, oh, good, India was not affected by the financial crisis.
Reddy was cautious on capital flows, kept a close vigil on the banking system's vulnerabilities, and delayed introduction of the type of derivative products that brought down the Western financial system. In the end, Reddy stood vindicated.
I felt strongly that we have to take precautionary measures. In a way, I felt somewhat cornered sometimes with some criticism, but I found by and large there was an element of understanding, and government also, while there were always discussions, at the end of the day the policy space was provided to me by the government, and that's something which we should concede. So this is the credit for success of managing the financial sector with stability while aiding growth, unprecedented growth, and maintaining price stability during the last 5 to 6 years should be really shared between the government and the Reserve Bank.
This was not the first crisis that former Governor Y.V. Reddy encountered in his 5 years in office. A year into the job, Reddy had to deal with the failure of Global Trust Bank, where things had gone horribly wrong. By 2004, it became apparent that Global Trust Bank had a negative net worth on account of overexposure to the capital market and mounting non-performing assets. The bank's reckless lending practices came out in the open, and it saw a run on deposits. It was time for swift, decisive action, with the central bank and the government acting in perfect coordination. That's just the combination Reddy pulled off. The RBI imposed a 3-month moratorium on deposit withdrawals to halt the run on the bank. Very soon, Global Trust Bank was forced to merge with the state-run Oriental Bank of Commerce. Many of the tactics Reddy used to deal with the bank's failure were roundly criticized. But the same techniques became very popular with Western regulators when the global financial crisis hit 4 years later.
I think that's extremely interesting case, and it will be very useful for the RBI to prepare a case study of that bank, because that was not, in a way, it was not a very large bank. Nowadays there is a debate, too large to fail. It's not necessary that something should be too large to fail. Something systemically important is also important. GTB had presence in critical sectors, that's one. Whatever the decision we had to take, it had to be quick, sudden, and well worked out, with full cooperation from the government and the banking industry. The lesson was more for the banking system than for RBI. The banking system got the lesson that if you are weak, you will not be allowed to survive. However powerful, however important. And that really went home. So I would say there are a lot more lessons in the banking industry, and after the next 3 to 4 years we were able to completely clean up the banking system. Mergers, acquisitions, closures, etc. From the Reserve Bank of India point of view, in some ways when I look back, we find many things that we did and which were criticized were exactly what was done after the crisis. Whether operating over the weekend was criticized, why did you do the weekend? But most of the actions now in the banks are over the weekend. But our law also was facilitating. For instance, in UK they had a problem. The law did not permit the type of mergers that we could do almost forcibly. But it is an extremely important lesson for the future also in terms of, I would say, lesson for the new regulatory framework that is under consideration in other countries.
From what could be easily controlled to what could not. In the past few decades, RBI has managed it all. Take for instance, the Asian currency crisis of 1997. Ex-Governor Bimal Jalan, who was appointed when the crisis was at its peak, recounts the enormity of the challenge.
It was the most difficult day of my entire executive career. The period within which the Asian crisis took place was no more than 15 days. We took anticipatory action at that time to float 2 bonds which were highly successful, NRI bonds, the India Resurgent Bond and also a development bond. So it increased our capacity to handle any fluctuations or any speculative attacks on the rupee. They became worse and worse for about a year, after the Asian crisis, because our external position was not that strong, as you know. We were not in difficulty, but I think it was 20 billion or something by way of reserves. And there was tremendous amount of speculative pressure on the rupee. And so you would have seen rupee would have declined by say 10%, 6%, 7% during the course of the day. So how to manage that problem was probably the most difficult one. And it was that everybody wanted to get out of the rupee, get into dollars. Even if you were, say, an exporter, you would have done well to keep, if this was a feeling, speculative feeling, to keep your dollars abroad and then encash them when the rupee had depreciated. So it was a very difficult period.
Which brings us to what was possibly the biggest challenge that the Indian economy has faced in the last few decades. The balance of payment crisis of 1991, when the country had to pledge its gold reserves. A very tough decision in a country that has for a long time placed its trust in the safety of the yellow metal.
We had borrowed money from the New York interbank market on behalf of the State Bank of India to purchase crude oil and other essential commodities, and that we could not repay because of balance of payment problem. At that time we had also approached the IMF, and the IMF had agreed to a loan, but at the same time they thought that we should apply our own gold reserves to the solution of our problem. This was one of my major challenges, and I think we were able to persuade the government to agree to the gold movement, and we pledged the gold which the Bank of England and the Bank of Japan pay off the debt, the immediate installment. I think that was a traumatic decision, a decision which forced the people to realize that we were in a crisis and that reforms needed to be made. I had further problems because during that time the Harshad Mehta scam took place, and I think I had to face the JPC inquiry because I had chased Harshad Mehta and identified the problem, and it was considered that the policeman who chased the thief was responsible for the thief's actions. And I think the Joint Parliamentary Committee spent a year and a half discussing various hypotheses. And I think my most memorable point was my defense of the RBI's role in the transaction and the support that I got from Dr. Manmohan Singh, who believed that RBI had its integrity intact and that I had done my bit to safeguard the situation and that I had no part in concealing any part of this transaction. I think that the Harshad Mehta incident also enabled us to look at the payment system and enabled us to institute banking sector reform.
The 90s changed the landscape of Indian banking forever. Over the decade, two committees headed by former RBI Governor Narasimham scripted the reform agenda for Indian banks.
What our 91 committee did was try to free the banking system from this nitpicking regulation, give regulation a more purposive character, make it much more effective, and not go into where you open a branch or how many people you have in a branch, but concentrate on aspects which would improve the productivity, the efficiency, and in the ultimate analysis, the profitability of banks. So asking banks to follow, have adequate capital. And one of the main recommendations of the 91 committee was to enhance capital ratios, to make capital in relation, enhance capital in relation to risk assets. And secondly, to follow a system of prudential norms for provisioning and risk management and project appraisal. And at the same time, we try to bring about internationally recognized system of accounting in banks, income recognition, which was absent before that. In fact, concept of non-performing assets, one might say, derives from the report of 91, where we classified in assets and said that those that didn't satisfy certain repayment norms should be declared non-performing. Paying attention to the quality of banking and quality of banking assets, having purposive but effective regulation rather than intrusive administrative control of the banks. That was the philosophy of 91, which also pervaded the 1998 recommendations. The point was that ownership of banks was not the issue. Operational flexibility and functional autonomy were what was required for the banking system.
The changes that were unleashed in the 1990s were a direct response to the excesses of state-directed socialism and the license permit Raj system of crony capitalism practiced in the previous 3 decades.
What should have been entrepreneurial decisions were really made by government. What to produce, where to produce, how to produce, at what price to sell, whom to sell. All these functions were taken by government rather than by the entrepreneurs. We were stifling enterprise and not allowing our economy to grow to its full potential. I'm talking about the 50s, 60s, and even into the 70s, when our growth rate was a dismal 3.5%, and with the population growth at around 2%, the per capita income growth was less than 1.5% per year, which was totally inadequate given the needs. And our growth was not up to our potential or what the needs dictated. So we needed to break out of this strict regimentation And frankly, even then our savings rate was not bad, but our capital efficiency was pretty poor.
Those dark days of low growth are behind us. Today the economy is a lot freer. Savings rates are rising and the country has a thriving stock market, a competitive industry and a far more efficient banking system.
Initially, against the background of the earlier banking development of our country, we chose only those which have an institutional base to become new banks. That is how ICICI or HDFC or even the unit trust were chosen to set up new banks. As you would see that some of these banks have become really very strong. Some of these banks, some of the private banks have emerged as really very large banks, and I think one of the private sector banks is the second largest bank in the country now. But some have not fared that well. They have either been merged with other banks or they have been absorbed by other banks.
The financial system today is much more effective in allocating capital to productive uses than was the case 3 decades ago. It wasn't an easy journey. It included big and small changes in policy, and many of them were driven by the Reserve Bank of India. For a decade since its inception in 1935, the Reserve Bank of India was a private shareholders' bank, an instrument of colonial masters. The RBI provided rupee resources freely to the government against sterling assets. Well, sometimes it provided them a little too freely, leading to high inflation. The central bank really came into its own in independent India. The bank was nationalized in 1949 with the enactment of the Banking Regulation Act, which mandated a comprehensive and formal structure of bank regulation and supervision. It was a time when rural India was hundreds of miles away from the banking system. The 60s was amongst the toughest periods. 3 poor monsoons and 2 wars had drained the economy. Essential commodities and services were scarce and expensive. Growth was low and unemployment was rising. All this forced a massive devaluation of the currency in 1966. But the situation kept getting worse. The resultant public anguish led Prime Minister Indira Gandhi to swing to the left. In July 1969, amidst severe opposition, Prime Minister Indira Gandhi nationalized 14 major commercial banks in what is described to be one of the swiftest economic decisions ever made in India. A decision that was accompanied by the resignation of Deputy Prime Minister and Finance Minister Morarji Desai. Soon thereafter, the Congress party would split into 2. And independent India would be presented with its first full-blown political crisis. Over the next 2 decades, RBI played its part in nation building. Nationalized banks made inroads into rural India. Industry got much needed access to capital, but the finances of the country were far from strong. India's import bill was ballooning. By 1986, India was facing severe strains on its balance of payments with the rest of the world. Imports were rising, exports were on the decline, and state-run businesses had monopolized production. With oil prices spiking during the first Gulf War, foreign exchange reserves dried to a trickle. India was close to bankruptcy in 1991, with a fiscal deficit equal to 12% of GDP and forex reserves of $1.2 billion, which were just enough for 3 weeks of imports. That's when the country pledged 67 tons of its gold reserves to Bank of England and Bank of America for a $600 million loan.
There was no alternative left. The foreign exchange reserves were very small. It was not even equal to 3 weeks imports, and there was a wide gap between exports and imports of goods and services, and therefore it had to be corrected. But we did not stop with that. A devaluation we had done before also. But now we not only devalued the currency, but changed, as I mentioned earlier, the exchange rate regime.
It was in these circumstances that former RBI Governor Manmohan Singh was appointed Finance Minister of the country. With Prime Minister P.V. Narasimha Rao's support, Singh turned the crisis on its head and made it into a perfect opportunity for unshackling the caged tiger.
The world has changed. Beyond recognition, we in this country have to wake up to the harsh new realities of this world.
That's how India woke up to a new dawn and began the process of opening up to the world. The license permit Raj was dismantled. Prohibitive import duties were slashed. Foreigners were allowed entry into Indian capital markets. The economy started to embrace modernity.
The crisis also enabled us to realize that we had to change our ways on various things. I think we moved towards convertibility. And I think that was a decision which originally thought was risky, but we played it by the ear, and convertibility meant that the market determined rates for the exchange, the rupee, was accepted, and that enabled much freer trade and portfolio investment into the country. And all the present FII inflows and FDI inflows would not have been conceivable if we had not done that.
The RBI did not leave the rupee to float freely. The market determined the exchange rate, but the central bank intervened to massage volatility and to cool the ardor of speculators whose one-way bets could lead the currency to swing dangerously in either direction.
We made two things absolutely clear and sure, that we are not going to be the prisoners of orthodoxy. And for example, there was always this feeling in the market that RBI would intervene at a particular exchange rate, or that we would have a targeted exchange rate, or that we wouldn't allow rupee to depreciate beyond a point. During the day, what we always did, in consultation with our entire foreign exchange management team, was that we would allow it to depreciate. And then the market starts feeling, will it not? So once that happened, then we would start coming into the market in a big way. So in 3-4 days, I mean, they all became very conscious that don't do massive risk, because the RBI now had the capacity, and that we will never intervene at the expected point, because there was a lot of speculation that RBI intervening, we would not intervene. Second, that we made no pretense of not sort of using, we had made no pretense at all that we were using the state bank, we were using some other bank. So nobody knew whether it was RBI or it was the actual requirement of dollars. So they were all guessing. So I think we beat the market at the market's game.
By 1997, India had a bold vision for moving toward a fully convertible currency in 3 years. But the external environment turned bleak with the onset of the Asian currency crisis in 1997. The large-scale flight of capital that threatened to cripple the tiger economies of East Asia made Indian policymakers question the wisdom of moving too quickly to a fully convertible capital account.
If you say mid-90s, the IMF believed fully that there should be full capital account convertibility, and it was more or less pushed. With the Asian crisis, there was a pause, At that point of time, this philosophy was introduced, which we also believed in at that point of time. I would say that you must have some preconditions. If preconditions such as fiscal, banking system, etc., if the preconditions are satisfied, then there will be a lot of benefits of full capital account convertibility.
A weak fisc has posed a severe challenge to the RBI, both as the government's debt manager and the country's monetary policy maker. A landmark move at damage control came in 1994 when RBI Governor Dr. C. Rangarajan got the government to agree to a phase-out issuance of ad hoc treasury bills. These ad hocs used to clear the pitch for the conduct of independent monetary policy. Their abolition and subsequent replacement with a rule-based ways and means advance to accommodate the government's overdraft went a long way in giving the RBI more control over money supply and price stability.
I would say there are two things that paved the way. One, of course, is the phasing out of the ad hoc treasury bills. And the other is the dismantling of the administrative structure of interest rates and introducing a system under which the government bond rates were market determined. That enabled for the first time for the Reserve Bank of India to undertake open market operations. Today we talk of repo facilities, reverse repo facilities, and so on and so forth. All that would not have been possible had it not been for the fact that at that particular time we dismantled the administrative structure of interest rates and compelled the government to go to the market and raise the funds at market determined rates of interest. I think the two together constituted important help in making the Reserve Bank of India pursue a monetary policy which is somewhat independent.
By the late 90s, the Indian financial system was moving to completely reform itself. 3 weak public sector banks got a new lease of life. State-run public finance institutions were revamped. The insurance sector was opened up and private sector banking took off in a big way. That isn't all. Prudential norms were adopted to ensure that Indian commercial banks were adequately capitalized and had clean balance sheets. In the first decade of the third millennium, Indian banking was on a roll. ATMs began to supplement branch banking. Online transactions slowly gained acceptance. A real-time gross settlement system was put in place. Meanwhile, the interest rate regime turned benign. The rupee was more or less stable and inflation was not too much of a worry. Aggressive private sector banks grew in size and stature, and apart from one-off incidents, the financial markets were working like a well-oiled machine.
RBI again was one of the earliest institutions, central bankers, to openly focus, articulate and work towards financial stability. The importance of financial stability was also flagged. So in some senses the Reserve Bank today is in a position to handle the future of the growth and stability with some sense of strength in the banking system and better understanding. And another contribution I would say is pegging the inflation expectations. We don't have inflation targeting in our country. And earlier it used to be inflation is 7, 8, some people used to say high, low, there was no number. And what we tried to do is we tried to put 5%, we created expectations that the moment it crosses 5%, that's something which we don't like. And we would like over the medium term to be in the range of 3% or 4%, consistent with the global trends. I think that, so these are some of the measures which should help.
So just how has the role of the RBI and that of its governor evolved over the past decade?
The whole economy has become more complex and different than was the case in, say, 10 years, even 10 years ago. And that's fortunate, I mean, for the betterment of India, but that makes the handling of the problem a little more difficult.
The complexity of the task became apparent in September 2008 with the collapse of Lehman Brothers. Immediately, interbank rates shot up in Mumbai. Dollar funding for Indian banks and companies dried up. the real economy started sputtering. By November, the gloom was palpable. Dr. Duvuri Subbarao, the present governor, had stepped into the scene just 9 days before Lehman filed for bankruptcy. Just how did he feel in those days of gloom and doom? Dr. Subbarao will answer that question and many more in a short while. Stay with us. A bureaucrat, economist, and the reigning RBI governor. 60-year-old Duvuri Subbarao is a man of many parts. An IAS from the 1972 batch and an alumnus of IIT Kanpur, Ohio State University and MIT, Subbarao held many public offices before he was appointed governor of the RBI. He has served as Finance Secretary and Secretary to the Prime Minister's Economic Advisory Council and was a lead economist at the World Bank, where he worked on public finance challenges in East Asia and Africa. Subbarao was Joint Secretary in the Department of Economic Affairs between 1988 and 1993, when economic reforms were initiated, and Finance Secretary of the Government of Andhra Pradesh between 1993 and 98.
Dr. Subbarao was Finance Secretary when I was Governor of the state of Andhra Pradesh. That is how I came into contact with him. And later on, when I was the Chairman of the Economic Advisory Council, we were looking for a secretary, and he had, Dr. Subbarao had just come back from his World Bank assignment. Once again, clarity is a strong point of Dr. Subbarao. He has the ability to cut through the complex web of arguments and go to the core of the issues. All this, once again, I was able to see, and that is why I brought him first as Secretary to the Economic Advisory Council, and later on, of course, he became the Finance Secretary and finally the Governor.
Subbarao took over as governor in early September 2008. Within days of his assuming office, Lehman Brothers collapsed, sending shockwaves around the world. How did he manage the crisis, and was he worried about a serious economic dislocation?
It was a classic case of baptism by fire. Post-September 2008, when world financial markets choked, confidence completely dried up, it became clear fairly soon that we were having a crisis of different dimensions, both in scope and sweep. It also became evident that India, despite all the talk about decoupling, was going to be impacted by the crisis. So we were driven by two considerations. First, that we must keep our money and credit markets functioning normally, and that we must ensure that liquidity stress does not trigger solvency cascades. So we were aiming three things actually: that we must maintain ample rupee liquidity, we must maintain comfortable dollar liquidity, and that we must ensure that credit flows to all productive sectors of the economy. There was, of course, criticism that our aggressive easing was an overreaction, criticism that our short-termism was compromising medium-term sustainability. But in the event, with the benefit of hindsight, now I can say that it was better to err on doing too much rather than doing too little.
But what was it like personally for you? Because when Lehman Brothers went down, you had what, some 9 days of experience as a central bank governor? Did you feel sort of under-equipped at any point in time? Did you have enough people guiding you, supporting you, giving you advice? Who did you rely on?
Yes, that's right. I was barely days into my job when Lehman Brothers collapsed. Coming into the Reserve Bank, actually, I was on a steep learning curve, and the learning curve got suddenly much, much steeper. Now that you ask me, I think I depended largely, if not entirely, on the Reserve Bank. There was, of course, high-level coordination meetings with the Prime Minister. There was a lot of learning from international conferences. And there was, of course, a lot of analysis, advice coming from think tanks, academia, from media. But in the ultimate analysis, I depended on the analysis of the staff of the Reserve Bank, on the advice of the senior management. The final call, of course, was mine.
Let's fast forward a little. Let's go to March 2009. Were you surprised by the speed of recovery, by the speed of asset price reflation?
To be honest, yes. Because this crisis was hitting us from the outside. And there was a lot of uncertainty, there was a lot of anxiety. And how the crisis would evolve was difficult to know and largely beyond our control. So even as I knew that our export sector is small, even as I knew that our financial sector is safe and sound, even as I was confident that the fundamental drivers of India's growth, growing entrepreneurism, rising productivity, they were all intact. But there was a concern that things are happening outside the country and we have to respond to them. And there was anxiety about which institution might fall which day, and there was anxiety about whether all the dirt had come out. So in the period between October 2008 and March 2009, there was uncertainty. The only comforting fact I would say was that we were not alone. There was uncertainty all around. Okay? And as I said, we had a silver lining in the dark clouds. So yes, looking back on the anxiety at that time, I would say that I was surprised by the speed of the recovery.
Joseph Stiglitz says that the crisis, the financial crisis, is not really over. What if he's right? What if the crisis resurfaces in the form of, let's say, investors losing faith in sovereign ratings, in fiat money? Are you prepared for such a scenario? Do you even consider it as a black swan in your calculations?
See, the mainstream view today is that the global economy is on its way to recovery. There is, of course, widely shared concern that the recovery is tepid, it's not robust enough. Some people believe that there's going to be a double-dip recession, another recession before we are on our way to a sustainable recovery. Some people believe that we are probably sowing the seeds of the next crisis in trying to resolve this crisis. So Joe Stiglitz is a noted economist, a Nobel laureate, an influential thinker, and I believe he's speaking for a lot of people. This denting of confidence in sovereign debt, in fiat money, I think that's partly triggered by the Dubai developments in November, and countries which have had a history of sovereign debt defaults and currency crisis, I think should be concerned. But as far as we are concerned in India, the entry of foreign debt into sovereign debt is quite limited. The share of FIIs in sovereign debt is quite limited. So I do not think we can we should be concerned about a sovereign debt default, and I believe that we will not have a crisis like that.
1 billion Indians are perfectly happy accepting and holding your IOUs. The crisis has really forced a lot of policymakers to reassess their assumptions. For instance, Alan Greenspan does say now that he was possibly wrong about some of the things that he believed in. Have you had to reassess some of your own assumptions?
Oh, definitely. So most certainly. You know, this crisis has been an intellectual challenge. It's reopened old questions, renewed old debates, attacked our stereotype views, and I believe that there's lots of new questions arising. As far as I'm concerned, for example, yes, the decoupling theory. It's ironic that people believed in the decoupling theory in an age of globalization, but I was, given the evidence at that time, I was persuaded. Now I know that it's not credible. At least the strong version of the decoupling theory is not credible. I also believe that if you ensured price stability and macroeconomic stability, you could ensure financial stability. Now I know that that is not true. You've got to guard financial stability as an explicit variable. And something where I did not necessarily reassess my beliefs, but was reiterated my beliefs, was about the financial sector development. Now, before the crisis, there was euphoria about the financial sector, that you could add value by sheer financial engineering. Now, there is realization that financial sector development has value, has importance, only to the extent it aids the growth of the real sector. Okay? So I believe that's very important, that there is realization about that across board.
What about financial globalization, fully mobile capital flows? Where did you stand on this debate before the crisis, and where do you stand on it now?
I stand the same place, actually. You know, I'm being a bit cliched, but pardon that. Our approach to financial sector liberalization, globalization, and capital account convertibility, we treat that as a process and not an event. There is a roadmap for that, and we are traversing along the roadmap. But the roadmap itself is dynamic, irrespective of the crisis, because we're going to recalibrate it along the way, depending on the developments both here and around the world. When people talk about financial sector globalization and India's approach to globalization, in particular Reserve Bank's worldview of financial globalization, they tend to look at it from a micro perspective. Okay? A corporate looks at it from his own point of view. But what is collectively optimal is not necessarily what is individually optimal. And I believe we in the Reserve Bank take the macro perspective.
Do you think the Reserve Bank needs to become more accountable to democratic institutions, let's say the Parliament?
There is accountability at two levels. Accountability for delivery of public service at the interface with the public. And there is accountability for our policies. Now, the first dimension of accountability, where we are accountable for public services, I believe that we need to be sensitive to reducing transaction costs without compromising on due diligence. You know, I get a lot of complaints, a lot of grievances about people having problems with banks. And I believe that we should be sensitive to that. And we are accountable as much as any other public agency. Accountability at the Parliament level. In a parliamentary system, there is accountability through the executive. And the Reserve Bank redeems its accountability through the Finance Ministry. And of course, the Reserve Bank and I as the governor, we appear and testify before parliamentary committees. So I believe there is a fair amount of accountability, and you know, it's a difficult balance of enforcing accountability and preserving the autonomy and independence of the institution. And this is an issue that's come up, that's been with us all through, and has come up again through the crisis. And I think that even as we should keep thinking about it, we should be concerned about maintaining the independence and autonomy of central banks.
Do you think the Reserve Bank of India has enough autonomy now?
I believe so, yes. Contrary to popular perception, we do enjoy autonomy, yes.
In the next 25 years, there will undoubtedly be more opportunities for the RBI to assert its autonomy. It will be called upon to bat for the common man, whose inflation tolerance is low and continuously falling. It will also be called upon to create preconditions for a thriving corporate bond market, so that the much-needed long-gestation infrastructure projects get financed without putting commercial banks' balance sheets at risk. Most crucially, the RBI will have to play a very important part in making sure every Indian in 2035 has access to finance in an economy brimming with enterprise, ingenuity and hope. RBI's centennial celebrations will take place in a nation of 1.6 billion people that's rich, stable, secure, caring and confident.